In what could be one of the most controversial tax shake-ups in recent memory, HMRC has issued a stark warning to UK taxpayers as the new Labour government hints at the possible introduction of a Robin Hood-style tax on wealth. With the country still reeling from economic turbulence, rising debt, and pressure on public services, the Treasury is keeping tight-lipped about future tax policy. But one thing is becoming increasingly clear: the wealthiest individuals in Britain could soon face a brand new tax burden. In this developing story, we take you inside the House of Commons, where political tensions flared after the Labour government refused to rule out implementing a wealth tax. What does this mean for you? For investors? And for the millions of working and middle-class families watching closely to see who will bear the weight of the next fiscal squeeze? Let's break it down. It all began with a pointed exchange inside Parliament. Conservative MP Mel Stride posed a simple but powerful question to Chief Secretary to the Treasury Darren Jones: will the new government introduce a wealth tax? The response? Anything but clear. Jones dodged the question with parliamentary finesse, saying he's a man that knows how this works. All of that happens with a forecast and a budget, which will happen in the autumn. The message was unmistakable. Labour won't confirm a wealth tax just yet, but they certainly haven't ruled it out either. Instead, Jones suggested that any decisions on taxes, whether increases or entirely new forms of taxation, will be revealed in the Chancellor's autumn budget, expected later this year. This, of course, has set alarm bells ringing across the financial sector. For high net worth individuals, investors, business owners, and even middle-class savers, this uncertainty brings growing anxiety. Because in today's climate, not ruling something out often speaks louder than denying it outright. And in the face of increasing calls to make the rich pay more, Labour may feel emboldened to act. For context, wealth taxes are often designed to target assets rather than income. This could include property, savings, investments, pension pots, luxury goods, and in extreme models, even inheritance or family-held assets. But what's most alarming is the potential breadth of such a move. Unlike income taxes, which are collected as you earn, wealth taxes can hit even those who are asset-rich but cash-poor. So, what is Labour's position exactly? On Monday, a spokesperson for Prime Minister Sir Keir Starmer was repeatedly asked whether the government intends to introduce a tax targeting the wealthiest in society. The response? The government is committed to the wealthiest in society paying their share in tax. He added, the Prime Minister has repeatedly said those with the broadest shoulders should carry the largest burden. Once again, no confirmation. No denial. Just a clear signal that tax policy will continue to shift in a direction focused on redistribution. The government went on to cite policies already enacted, closing tax loopholes for non-domiciled residents, imposing taxes on private jets, and ensuring that the top 1% of earners contribute nearly one-third of total UK tax revenue. Yet critics say this simply isn't enough. The UK faces growing fiscal pressure. NHS waiting lists, school funding gaps, housing shortages, and a strained welfare system mean the new government must find new revenue sources, and quickly. Tax experts and economists now believe a wealth tax could become an unavoidable lever for the Chancellor come autumn. Let's remember, the UK government is grappling with nearly £2.50 trillion in national debt. And with interest payments on that debt rising due to inflation and borrowing, the options are limited. Raising income tax is politically risky. Cutting public services is deeply unpopular. But taxing wealth? That's something many voters support, especially during a cost of living crisis. A poll conducted in 2023 showed that nearly 70% of the public support higher taxes on the very wealthy. And Labour knows this. So, what would a Robin Hood-style tax actually look like? It could involve a one-off wealth levy on those with assets above a certain threshold, say, £1 million or more. It might target unearned income from investments, shares, or second homes. Or, it could reintroduce changes to inheritance tax that affect middle-class families attempting to pass down wealth. In more radical scenarios, we could even see annual wealth declarations required for households over a certain threshold, allowing HMRC to track asset values and apply tiered taxes accordingly. Sound far-fetched? Perhaps. But France had a wealth tax. Spain and Norway still do. And now the UK might follow suit. Unsurprisingly, this ambiguity is already triggering backlash from business leaders and high-income earners. Business owners warn that even floating the idea of a wealth tax could drive investment out of the UK and force entrepreneurs to shift their assets abroad. One financial analyst we spoke to stated bluntly, wealth doesn't just sit and wait to be taxed. It moves fast. And if Labour is serious about attracting long-term capital, this mixed messaging isn't helping. But Darren Jones defended the government's approach, saying that investors are responding positively to the Labour Party's long-term budgeting, fiscal rules, and planning reforms designed to stimulate economic growth. He claimed that business confidence is actually increasing under Labour despite the tax uncertainty. History has shown us what happens when tax policy swings too far. In the 1970s, the UK had a top marginal tax rate of 83% with a 15% surcharge on investment income. That's a staggering 98% top rate. What followed? A mass exodus of high earners, stalling economic growth, and decades of tax policy reversals. Could we see a repeat? That depends entirely on what Labour chooses to do next. All eyes now turn to the autumn budget, when Chancellor Rachel Reeves is expected to unveil the full fiscal strategy for the next 5 years. If a wealth tax is introduced, it could take multiple forms. And it's likely to be framed around fairness, closing the gap, and protecting public services. Expect phrases like those with the broadest shoulders, leveling the playing field, and ensuring sustainability of the public finances to dominate the headlines. But the stakes couldn't be higher. Introduce a poorly designed wealth tax, and the UK risks losing key investors and damaging the fragile post-Brexit recovery. Skip reform altogether, and Labour may face backlash from their own supporters demanding economic justice. For ordinary households, the big takeaway is this: wealth taxes don't just affect billionaires. They can impact pensions, ISAs, inherited property, savings accounts, second homes, and even small business equity. If you're nearing retirement, own property, or have family savings, you could be affected. Now is the time to review your assets, speak to financial advisors, and stay informed. Because if Labour follows through with these hinted reforms, it won't just be the richest 1% feeling the pressure. If you found this report helpful, don't forget to subscribe to our channel for more breaking updates on HMRC tax policy, DWP benefits, and crucial financial news that affects millions across the UK. We're here to help you understand what's changing, how it impacts your income, and what you can do to stay one step ahead of government reforms. From state pension updates and universal credit changes to the hidden tax traps buried in legislation, we break it all down in clear, simple language that puts your money first. Make sure you turn on notifications so you never miss an urgent update, especially as we head toward the Chancellor's autumn budget, where life-changing decisions will be made about pensions, wealth, and household taxes. Leave us a comment below with your thoughts on the proposed wealth tax or any other reforms you're concerned about. And if you know someone who might be affected by this, share this video with them. Remember, staying informed is your best defense in uncertain times.